Hello everyone. In this video, we are going to learn about the statement of comprehensive income. In the last video, we discussed the income statement. If you look at an income statement, after net income, you will notice another section called Other Comprehensive Income, Other Comprehensive Income, or Other Comprehensive Loss. This is what we'll discuss today. Remember, the balance sheet shows assets, liabilities, and equity at a point in time. The income statement shows revenues and expenses over a period. On the balance sheet, assets are shown at their fair value current market price. Any unrealized gain or loss, meaning the price change before selling, does not go to the income statement. An unrealized gain or loss is the increase or decrease in the value of an asset that a company, or person, still owns but has not yet sold. When the current market value of the asset is higher than the purchase price, but the asset has not been sold, it had to be recorded somewhere, so it goes to Other Comprehensive Income statement. Think of Other Comprehensive Income as a bridge. It records changes that affect equity, but are kept outside net income. Profits from net income go to retained earnings under equity. Unrealized gains or losses go to Accumulated Other Comprehensive Income, AOCI, also under equity. Unlike net income, which closes to retained earnings each year, Accumulated Other Comprehensive Income keeps accumulating over time. This way, shareholders' equity reflects not only retained earnings but also all unrealized gains and losses that have built up over the years. Now, companies can report comprehensive income in two ways. First option is a single continuous statement. Here, net income and its components are presented, followed by other comprehensive income and its components, ending with total comprehensive income in one flow. The second option is to present two consecutive statements. The first is the income statement, which reports net income. The second is the statement of comprehensive income, which starts with that net income, then adds other comprehensive income and its components, ending with total comprehensive income. Both formats are acceptable. The choice depends on the company's reporting preference. Now let's study what goes into Other Comprehensive Income. These are items that don't affect net income immediately, but still change shareholders' equity through Accumulated Other Comprehensive Income, or AOCI. Item 1. Foreign currency translation adjustments arise when consolidating financial statements of foreign subsidiaries. Exchange rate changes affect the reported value of assets or liabilities in US dollars. Example: a US parent company has a European subsidiary with €1 million assets. If the euro weakens against the dollar, the translated dollar value drops. This translation loss is recorded in OCI, not net income. Item 2. Gains or losses on hedges of net investment in foreign entity. When a company uses forward contracts or loans to hedge foreign subsidiaries, gains or losses from hedge are reported in OCI. Example: if a US company invests in a UK subsidiary and borrows in pounds to hedge currency risk, changes in the pound-dollar rate impact the hedge value. The resulting gain or loss goes into Other Comprehensive Income. Item 3. Intra-entity foreign currency transactions, long-term nature. Intra-company loans that are, in substance, permanent investments. Currency fluctuations on these loans are recorded in Other Comprehensive Income. Example: parent lends $10 million to a foreign subsidiary with no plan to repay soon. Exchange rate changes affect the loan balance. These unrealized changes go to Other Comprehensive Income, not income. Item 4. Gains or losses on derivative instruments, cash flow hedges, derivatives used to hedge forecasted transactions. Effective portion of hedge gain or loss goes to Other Comprehensive Income. Later reclassified to net income when the forecasted transaction affects earnings. Example: a company expects to purchase raw materials in 6 months and uses a futures contract. If the derivative gains $50,000, this goes into Other Comprehensive Income until the purchase happens, then reclassified into COGS when inventory is sold. Item 5. Unrealized gains or losses on available-for-sale debt securities. Market value changes of available-for-sale debt securities, not yet sold, are recorded in Other Comprehensive Income. Example: company buys corporate bonds for $100,000. At year end, fair value equal to $104,000. The $4,000 gain goes into other comprehensive income until the bond is sold. Item 6. Pension or post-retirement benefits adjustments. Gains or losses from actuarial changes, prior service costs, or transition obligations is not immediately gone to net income, instead deferred into OCI. Example: if pension obligations increase by $200,000 due to a change in discount rate, this actuarial loss is reported in other comprehensive income first, then amortized gradually into net income through pension expense. Item 7. Changes in fair value due to instrument-specific credit risk, fair value option. If a company elects the fair value option for its own liabilities, changes in value due to its own credit risk are recorded in other comprehensive income. Example: company issues bonds at $10 million. Later, its own credit risk worsens, reducing the liability's fair value by $300,000. That $300,000 gain, because company would settle at lower amount, goes into other comprehensive income, not net income.